Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. We're now looking at chapter number 5, and I want to look at some account balances. By now, you've already studied journal entries and adjusting entries, and hopefully you've made some financial statements. I want to take a look before we go into anything deeper. I want to make sure that you understand the various account balances and what they might mean. So we're going to look at about 12 of these, and I want to make sure that you know what they represent and where they are reported. Because if you don't get this right now, then you'll struggle in the future. But I want to make sure before we go one step further that you're comfortable with the various account balances. Before we move on, I want to remind you of one thing I have said in other videos, and that is you can really split all accounts into two types: assets and liabilities are talking about balances right now. If you're looking at assets like cash or inventory or prepaid rent or buildings, it's talking about that balance right now. Liabilities like accounts payable or notes payable or salary payable is talking about what you owe right now. Those accounts are basically looking at what happens or what has happened right now. All of the other accounts are going to measure the changes in the past. They refer to what has happened in the past. Normally, they're talking about the effect in the past that they've had on net assets. Revenues, for example, in the past have increased net assets. Expenses in the past have decreased net assets. Capital stock in the past has been an increase in net assets. Now, when we talk about the past, what time period are we talking about? For almost all accounts, the time period, at least in this course, is going to be 1 year. So when we measure revenues, we'll measure it as the amount of revenues in the past for the past year. Now, you could do it for every 3 months or some other time period, but for simplicity's sake, we'll do it for the past year. A few other accounts, such as capital stock, is talking about the past since the company first began. So capital stock says how much increase in net assets occurred in this company since it first began. So you've got assets and liabilities that talk about now. You've got revenues, expenses, and a few other accounts that talk about the changes in net asset in the past, and that's probably going to be the past year. And then you have a few accounts like capital stock that talks about the change in net assets since the company first began. That's just one way to think about the various account balances and what they represent. At least when I took this course, I found that very helpful to kind of distinguish the various account balances that I was facing. Now, the 12 accounts that we're going to look at, and I just picked these almost at random: prepaid inventory, prepaid insurance, inventory, sales revenue, dividends distributed, cost of goods sold, accounts payable, deferred revenue, gain on sale of land, salary expense, salary payable, accounts receivable, and retained earnings. If you go to a company's ledger, you'll find a T account for each one of these accounts. What does the account mean? What does the account represent? And where is it shown on the financial statements? I believe, and I believe this very strongly, that if you're comfortable with these 12, then you're probably going to be comfortable with any account that I can come up with, and you're going to be able to use it in preparing financial statements or understanding financial statements. So we're going to look at these 12, 3 at a time, and we're going to talk about what they mean and where you would see them on a set of financial statements. So our first 3 are prepaid insurance, inventory, and sales revenue. And just for help, or just for sake of assistance, I have put in whether the typical balance is a debit or credit. Prepaid insurance, for example, is an asset. Inventory is an asset. Both of those accounts normally have debit balance. Sales revenue, quite obviously, is a revenue account, and revenue accounts typically have credit balances. So just as a starting spot, I thought that might help us as we look at these 12 accounts. Now, let's take prepaid insurance. As I've already said, that's an asset. It means that it's something that we own or control that has future economic benefit. Now, that economic benefit normally means that it will help us in our business so that we can generate revenue. And prepaid insurance, of course, means that we have paid for insurance that will take place or cover us or cover our company in the future. So you might pay 6 months of fire insurance or 4 months of insurance on the property in some other way that provides a benefit. It provides coverage. It provides protection in the future. So that's an asset. And as an asset, it will appear in the company's balance sheet. Now, prepaid insurance, unless it covers more than a year, will not just be an asset, it will actually be a current asset. Inventory, likewise, is an asset. And likewise, inventory is a current asset because you typically use it up within a year. It is the merchandise that the company is holding for resale purposes that they hope to sell. So if you go into a hardware store, the hammers, the saws, the nails, all of those would be inventory because that's what they're holding to sell. As a current asset, inventory, like prepaid insurance, is reported on the balance sheet. That's where you find that account. Sales revenue, since it's not an asset or a liability, is measuring something in the past. And what it's measuring is the inflow that you had from selling goods and services. So if you're a hardware store and you sold $245,000 in hardware, the inflow from that sale over the past year would be your sales revenue. As a revenue, it is reported at the beginning of your income statement. Now, my guess is that none of these are going to surprise you. They're covered in the book and they're covered in previous problems. I simply want to look at them one more time before we go any further with a financial accounting, just to make sure that you have this balance, these balances down very smoothly. Prepaid insurance is a current asset. Inventory is a current asset. They're reported on the balance sheet. Sales revenue is the measure of the inflow or increase in net assets from selling goods or services. That appears at the beginning of the income statement. Did you know that? And of course you did. But can you use it? That's what we want. It's not just learning the material, it's being able to use it so that you can understand what the company is telling you. Our next three accounts: dividends distributed, cost of goods sold, accounts payable. Dividends distributed measures over the past period, the past year, the amount of assets or net assets given to owners as a reward for ownership. So if a company pays a dividend of $12,000 to its owners as a reward for being the owners of a successful company, that's measured as a dividends distributed, and it reported on the statement of retained earnings. It is not reported on the income statement. It is not an expense because it doesn't help you generate revenue. Dividends distributed is simply a sharing of the net assets with the owners as a reward for the company, for them being owners of a company that's had success. Where does it appear? In the statement of retained earnings. Cost of goods sold is on the income statement. It is an expense, And it's an expense that measures the outflow of inventory that is sold. So again, if you're running a hardware store and you sell nails, we'll assume, and those nails had a cost to you of $111, then the cost of goods sold, as the name implies, is $111. It's normally reported near the top of the income statement. Often it's reported directly with the sales revenue. Cost of goods sold is an expense. It appears in the income statement. It is a reflection of the decrease or outflow of net assets from selling goods or services. The specific good, in this case, is inventory. And accounts payable is a liability. It's normally a short-term liability that has to be paid within a year. So quite often, almost always, accounts payable is labeled as a current liability. And as with all liabilities, it will appear on the balance sheet. It is a debt that the company has for buying things like merchandise or supplies, where it bought the item on credit, but it did not sign a note. It simply said, I want to buy these nails, I want to buy this hardware, and I will pay you in 30 days or 60 days or whatever they agree upon. It's less formal than a note payable, and normally it's going to be paid in a fairly short period of time. Those are the next three accounts: dividends distributed, cost of goods sold, and accounts payable. Is there anything there that you are not comfortable with? We're trying to establish exactly what you need to know to do well in this course. Here's our next three: deferred revenue, gain on sale of land, salary expense. Deferred revenue is where the company has received a payment, but the performance obligation has not yet been fulfilled. Therefore, the money that you get creates a liability or an obligation, because you either have to finish the performance obligation or you have to give the money back. So a deferred revenue appears very much like a liability, because if you don't do the work, you have to give the money you receive back. It is money you have received for revenue, but you have not yet fulfilled or finished the performance obligation. As a liability, it's reported on the balance sheet, and hopefully the company will finish the performance obligation, and at that point it will get moved to the income statement and be reported as a revenue. But the performance obligation has to be satisfied. Gain on sale of land is on the income statement. It indicates that the company has sold land and that they're not in the primary business of selling land. This is something that's tangential to the business. If it's a hardware store, then selling hardware, selling nails, selling paint brushes is the primary operation. Selling a piece of land, possibly out behind the store, is simply a different type of thing. It's not part of the primary operations, and the company made a gain on that, meaning that they got more than what the book value of that property was. So if the book value of the land was $100 and they sold it for $120, then they would have a gain of $20. Notice that inventory is part of the primary operations. So when you sell inventory, you have revenue and you have cost of goods sold. When you sell something that's not a primary part of the business, you either have a gain if they got more than the book value, or you have a loss if they got less. The gain on the sale of the land is reported to the income statement, but it's reported toward the bottom. The primary operations, selling the hardware, is at the top of the income statement. The other related things, like gain on sale of land, is reported at the bottom or toward the bottom of the income statement. Salary expense is a measure of the outflow of net assets In this case, the expense is what the employees have, what the company has incurred for the employees. The employees have earned this money. It has been incurred. So let's assume, for example, that the employees have earned $100,000. Then that would be your salary expense because that's been incurred. Even if it's not all been paid, it's been incurred. So if, for example, you paid $90,000, then you would have a salary payable, a liability for the other 10. This is the total amount that's been earned. This was what was paid, and this is what's not yet been paid. Salary expense is an operational expense, an operating expense, and goes on the income statement. Typically on the income statement, you have sales minus cost of goods sold to get gross profit. And then you have your operating expenses, and salary expense is one of those operating expenses that's reported in that way. So deferred revenue, you've received the money, but you've not yet completed the performance obligation. Gain on sale of land, you've sold something, land in this case, that was not part of the primary operation of the business. And salary expense is the amount that the employees have earned that has been incurred so far. Whether it's been paid or not, it has been incurred. And our final three, just to give us a good rundown on a variety of accounts, is going to be salary payable, accounts receivable, and retained earnings, which is always a little more complicated. Salary payable is a liability. It's very often a current liability because you normally pay it fairly quickly. And it's the part of the cost that has not yet been paid. So for example, if the employees have earned $100,000, then your salary expense is $100,000. If they were paid $90,000, then cash goes down $90,000. But the other $10,000, the part that you have not yet paid, is that salary payable. It's the amount that they have earned, but you have not yet paid them. It's a liability, and therefore it's a liability. It's reported on the company's balance sheet. Accounts receivable is the amount that your customers owe you. So you sell hardware, the customers tell you they'll come back at the first of the month and pay you. That's an account receivable. They owe you that money until they pay it. That goes down as an asset because most customers pay fairly quickly. That's typically reported as a current asset. And like all other assets, that's reported on the company's balance sheet. And finally, retained earnings. Retained earnings is reported or is computed in the statement of retained earnings. And the statement of retained earnings is the beginning balance for that year, plus the net income, minus the dividends you've distributed to your owners that period to get the ending retained earnings as of the balance sheet date. That figure then is reported on the balance sheet, and that figure is reported within stockholders' equity section of the balance sheet. Now, the retained earnings can be a credit balance if the net income is greater than all dividends, then that number is a credit. On the other hand, if the company has not done so well, if all net income is lower than all dividends, then that number is reported as a debit. Retained earnings means all of the net income since the company first began operating, less all of the dividends since the company first began its operations. Those are 12 accounts that you'll see in almost every set of financial statements. It's still early in this course, but I want you to get a good, strong understanding of these 12 basic accounts. What do they mean? Where are they reported? How do they show up to decision makers to help them make wise decisions? If you can get these 12 accounts down fairly well, that's a major step in understanding financial statements and making wise decisions. My name is Joe Hoyle. I am a co-author of the financial accounting textbook that you're using. I hope that chapter 5 has been a great chapter for you. It ties together a lot of the material and starts to show you what a real set of financial statements look like. If you have a moment, go to the internet, put in a company that you might be interested in, and search for the financial statements or the annual report and see what you can find. I want this course to be outside of the textbook because the world is full of financial accounting information. You might as well get used to looking at real information and not just textbook information. Again, this is Joe Hoyle. Have a great day. Take care. Bye-bye.